Okay, so I think high-yield savings accounts were a huge upgrade for a lot of people. Like if you moved your cash out of a big bank savings account and into something paying 4% or 4.5%, that was not a small thing. That was real money. But I also think this is where a lot of people stop. They hear high-yield savings account. They see a bigger number than their old bank was paying, and they think, okay, I fixed the problem. And maybe you fixed part of it, but not necessarily all of it, because the bigger question is not, is this better than my old savings account? It is, what is the bank doing with my cash after I give it to them, and could I be getting closer to that return myself? So let me show you what I mean. Imagine two people. Maya keeps $20,000 in a regular savings account at a traditional bank, and Jordan keeps the same $20,000 in a high-yield savings account. No, Maya's bank is paying around the national average for savings accounts. That is about 0.38% APY. So on $20,000, Maya earns about $76 a year. That is roughly $6.33 a month. Basically one fast food meal, depending where you live. But the part people miss is what happens on the other side. The bank does not just let that money sit there politely. They use deposits like Maya's to make loans, buy securities, manage liquidity, and earn a spread. And that spread is the whole business. The average net interest margin for U.S. banks has been around 3.39%, which was the highest level since 2019. So, if the bank can earn 3.39% on money like that, and Maya gets 0.38%, the difference is about 3.01%. On $20,000, that is roughly $602 a year captured by the bank, while Maya gets $76. And that is just one version of the spread. If someone carries a credit card balance, the average APR in early 2026 was around 21%. So the bank might pay almost nothing on deposits, then lend money out at 21%. That is a spread of more than 20 percentage points. Auto loans might be around 7.5%. Mortgages around 6.8%. Personal loans around 12%. And even if the bank does something very plain, like park money in short-term treasuries. 3-month bills have been around 3.6%. So the bank can earn 3.6%, pay a saver 0.38%, and keep the difference. That is not evil, that is banking. But once you see it, you start asking a different question. Why am I accepting the lowest slice of a return that the bank is able to access with my own cash? And it is not just interest. Banks also make money from fees. Overdraft fees, ATM fees, maintenance fees, service fees. In 1 year, U.S. banks collected an estimated $12.1 billion from overdraft, NSF, ATM maintenance, and other service fees. JP Chase collected over $1 billion in overdraft fees in 2024. Wells Fargo was close to that too. And then there is interchange revenue, float on pending transactions, and even anonymized spending data. So again, the point is not that banks are magic. The point is that your cash is productive for them. The question is whether it is productive enough for you. Now this is where Jordan looks smarter. Jordan has the same $20,000, but in a high-yield savings account paying 4.5%. So instead of earning $76 a year, Jordan earns about $900. That is a massive difference. That is more than 10 times what Maya gets. And honestly, if the only two choices are a normal savings account or a high-yield savings account, Jordan is clearly in the better spot. But there are still some catches. Zone catch is that a lot of these rates are advertised as up to 4.5%, up to 5%, up to whatever gets you to click. Sometimes the best rate only applies to the first $500, or the first $1,000. Sometimes it is a promo rate that drops after 90 days. Sometimes there are balance tiers, minimums, or little conditions you have to read carefully. And even when the rate is real, the interest is usually taxed as ordinary income. So if Jordan earns $900 and is in a 22% federal bracket, plus 5% state tax, that is 27% in total. So the $900 becomes about $657 after taxes, still much better than Maya. Not even close. But it is not really $900 that Jordan keeps. And the bank is still the middleman. They are just sharing a larger piece with Jordan than Maya's bank shared with her. So now the better comparison is not traditional savings versus high-yield savings. It is traditional savings, high-yield savings, and short-term treasuries. So let's keep the same $20,000. Maya uses a traditional savings account at 0.38% APY, she earns $76 gross, and after tax. Maybe around $55. Jordan uses a high-yield savings account at 4.5%. He earns $900 gross, and after a 27% combined tax rate, keeps around $657. Now a third person uses a short-term Treasury ETF, something like SGOV as of April 2026. Its 12-month trailing yield was around 3.95%. Its 30-day SEC yield was around 3.55%. So on $20,000, that might be around $790 gross using the trailing yield, or around $710 using the current 30-day yield. But Treasury interest is generally exempt from state and local income taxes. So if this person only pays the 22% federal tax, then on the trailing yield example, they keep roughly $616. And SGOV has an expense ratio of about 0.09%. On $20,000, that is about $18 a year. So yes, if your high-yield savings account is truly paying 4.5%, and it stays there, and your tax situation is simple, the HYSA might still come out ahead on the raw math. But that is not the whole picture. HYSA rates can change whenever the bank changes them. They can drop the rate quietly, they can run a promo and then pull it down. And if you live in a high-tax state, the Treasury tax treatment can matter more than people think. So I would not say every person should dump their high-yield savings account tomorrow. That is too simple. But I would say do not treat it like the final answer. It may be a middle step. Better than the old bank, still not always the best place for idle cash. So what do you actually do? First, keep a checking account. You still need a normal account for rent, bills, groceries, debit card transactions, and whatever money has to move quickly. This is not about making your daily life annoying. It is about separating spending cash from idle cash. So look at your accounts and ask, what money is just sitting there? Emergency fund, money, cash waiting to be invested. Money for a down payment, money for a car. Money you need in the next year or two, but not today, at 3 p.m. That is the money you should look at more carefully. Option 1 is a Treasury bill ETF like SGOV. You can buy it through a regular brokerage, like Fidelity, Schwab, Robinhood, Webull, or whatever platform you use. It holds very short-term Treasury bills, usually maturing in 3 months or less. It pays a monthly dividend. You can sell it during market hours. The price tends to stay around $100, because the fund is built around short-term government debt. And the yield has recently been in that 3.55% to 3.95% range, depending which yield measure you are looking at. You still have rate risk in the sense that yields can change. But you are getting much closer to the Treasury yield directly, instead of letting a bank capture most of it. Option 2 is TreasuryDirect. That is the US government website where you can buy Treasury bills directly at auction. No brokerage, no ETF, no expense ratio. You can choose maturities like 4 weeks, 8 weeks, 13 weeks, 26 weeks, or up to 52 weeks. The trade-off is convenience. TreasuryDirect is not exactly the smoothest modern app. And if you need the money early, it is less convenient than selling an ETF inside a brokerage account. So for some people, it is great. For others, it feels like too much friction. Option 3 is a money market fund. Fidelity, Schwab, Vanguard, and other brokerages all have money market funds. These funds usually hold short-term government securities, Treasury bills, repurchase agreements, or other high-quality short-term debt. They are designed to be liquid. They often pay competitive yields. And if you choose a Treasury-only or government-focused fund, some or most of the income may also get favorable state tax treatment. Again, you have to read the details. Not every money market fund is the same, but for idle cash, it is at least worth comparing. Now the biggest objection is usually, but what about FDIC insurance? And that is fair. FDIC insurance protects up to $250,000 per depositor, per insured bank, per ownership category. That is one reason bank accounts feel safe. But Treasury bills are backed by the US federal government. So with T-bills, you are basically lending directly to the same government that backs the banking system. That does not mean nothing can ever go wrong in markets or operations. But from a credit risk perspective, short treasuries are about as close to the base layer as it gets. The second objection is access. People say, I need my emergency fund instantly, and I get that. So keep some money in checking or savings for true instant access. But ask yourself honestly, how often do you need the entire emergency fund within the next 10 minutes? For most people, most emergencies do not require every dollar that fast. A brokerage sale might take 1 or 2 business days to settle. That is not perfect, but it is workable for a lot of situations, if you keep enough cash in checking for the immediate layer. So the real move is not close every bank account. That would be ridiculous. The move is to stop letting all of your idle cash sit in the place where the bank captures most of the yield. Because once you understand what is happening, the old setup feels different. Your bank pays you a fraction of a percent. Then it lends, invests, charges fees, earns spreads, and builds a whole business on the money customers leave there. And the customer says, well, at least I got $6 this month. That is the part I think people should question. Not because high-yield savings accounts are bad, they are not. They are often much better than traditional bank savings. But because in 2026, you have more options than just bad bank account or slightly better bank account. You can compare HYSA against Treasury ETFs against Treasury bills, directly, against money market funds, against your actual tax situation, against how quickly you really need the money. And once you do that, the question changes. It is not which bank is being generous. It is why am I letting the bank decide how much of my cash yield I get to keep. So keep your spending money liquid, keep your emergency setup simple. But for the cash that is just sitting there, at least look one layer deeper. Because your money is already working. The only question is whether it is working mostly for you or mostly for the bank.